There are some life insurance agents who want you to believe that they know all the secrets the wealthy use to gain an advantage with life insurance when it comes to their wealth building efforts. These are things that you won't learn in any sort of mainstream format, but rather these are closely guarded secrets that have been passed down inside close-knit circles of highly sophisticated and trained advisors. Most of these presentations are half-baked and riddled with a few inaccuracies, but some of them are downright dangerous. And here is one such example.
That now leaves you at the end of the year, you made about $15,000 on that money. Well, here's what you need to understand. You see the $7,500 that it cost you to take out that loan, ideally, because you're taking it out as a loan, the interest that you pay on that loan is not taxable, right? So you get to deduct the $7,500 from the $15,000. That means you're only paying taxes on $7,500 as opposed to the $15,000. So in this example, at $15,000, you would have paid $4,500, but in this example, you're paying $2,250 in taxes after subtracting the loan that you took out.
There are a few problems with this video, but the chief problem is the suggestion that you can take a deduction from the interest that accumulates on a life insurance policy loan. This is something you simply cannot do. The tax code is extremely clear about this. Lots of life insurance agents like to reference IRC section 7702. It gives them a certain degree of authoritative legitimacy in their presentations. And this section of the tax code speaks to what is and what is not life insurance, and therefore what benefits from the favorable attributes of a life insurance contract. But many fewer agents like to talk about IRC section 264, as this is the part of the tax code that speaks to the things you cannot do taxability-wise with a life insurance contract. From the dawn of the U.S. federal income tax, life insurance has played a sometimes frustrating role. Congress understood the benefits that life insurance brought to greater society and bestowed upon it a number of really cool tax features. But the life insurance industry itself was a bit too quick to seize upon the opportunity of what it saw as vagary in the tax code to exploit this for its advantage and to try and skirt the spirit of the law through tactical technicality, thus beginning a multi-decades cat and mouse game between Congress and the life insurance industry. And Section 264 of the tax code exists as a way to try and clarify some of the things the insurance industry attempted to make a reality. Now, like all good tall tales, there is a little sliver of truth, but once we put that sliver under the microscope, we start to realize that it doesn't apply, at least to the claims that are being made. It is true that you can take a loan and acquire income-producing assets, and the interest that accumulates on those loans, in some cases, is tax deductible. But IRS Form 4952, the form that you would file to claim this deduction, explicitly mentions Section 264 and the prohibited deductions therein, chiefly interest that accumulates on a life insurance policy loan. Furthermore, there's case law that tests the deductibility of loan interest on a life insurance policy, case law that took place in the 1960s. This is by no means a new frontier. The summation of that case law basically decided that life insurance policy loans lack economic substance, or to put another way, they don't actually pose any real risk to the policyholder's borrower and therefore are ineligible for a deduction that would be taken on Form 4952. There are also a couple of exceptions to the rules set out in IRC Section 264, but they are very unique and they apply to very few circumstances, and even then they have limitations. The life insurance policy must be business owned. It must cover the life of a key person, a director, officer, or owner with at least 20% stake in the business. At that point, the loan could be eligible for deduction, but there are limitations. There's a $50,000 cap on indebtedness, not interest, but indebtedness. So from the video example of a $150,000 loan, only one-third, $50,000, would be eligible for deductible consideration. Furthermore, there's a cap on the interest rate that is allowed when taking a deduction. It's tied to the Moody's Corporate Bond Index. So right now, a 5% number, which is what the video uses, is within the range of reasonableness. But a few years ago, this would have been far too high because the Moody's rate was significantly below this. But going back to the video and refining it for these rules, and let's just pretend that in this case, the life insurance policy is business owned and covering one of the requisite people mentioned. The total deductible amount that would be allowed is $2,500, not $7,500. And just to be clear and reiterate the point, an individually owned life insurance policy is completely ineligible for any of this. So if it's not business owned, it's owned by you, and you go out and make an investment by taking a loan against the policy and buying whatever the asset is, the interest that accumulates on that loan as an individually owned life insurance policy is not eligible for any tax deduction under the current U.S. tax code. But if you do own a life insurance policy and you are looking for a way to acquire an asset via a loan taken against that policy, and you really, really want a tax deduction, there is potentially one way you could go about doing this. You would take your life insurance policy to a bank and pledge it as collateral for a loan issued by that bank. This would put the option of deducting the loan interest back on the table, at least potentially. Now, the process of getting a loan in this fashion is far more involved than I'm making it sound, and it is way more involved than simply taking a life insurance policy loan. But there are times it can make sense because maybe interest rates would be less than the life insurance company would charge you. And again, putting tax deductibility on the table as an option may also create a greater incentive to take this route versus a traditional life insurance policy loan. Just understand that a traditional life insurance policy loan does not give you the option to deduct the interest. But there's something else I want to point out on the subject of all of this as it relates to the example in the video and using your cash value as a source of funds to go out and pursue additional investment activity. The original example from the video involved simply liquidating $50,000 of cash from theoretically a savings account and buying into an investment and netting $11,500 as overall benefit from the investment. Then it dives into this complicated scenario of using a life insurance policy loan and taking a deduction to further buoy the net return from the other investment, which is not permissible. But if we just look at the numbers as they relate to how the cash value in the life insurance policy would grow and what sort of net investment return you would get from that investment, that comes out to $12,000, which is $500 more than the example where you just liquidate cash from an account. So you can use life insurance to do this, and you do net a larger result without taking any sort of tax deduction. And while you may look at this and think that that $500 difference is pretty small and perhaps meaningless, I'll remind you that there are a number of things you can do marginally to increase your results, compounding over years, that could have a pretty significant impact on your overall net worth and how it grows. So this is to say, you can take this approach, having cash in a life insurance policy and using a loan from the policy as a way to acquire other assets, and it could very likely produce greater growth in your overall net worth. But don't get caught up in the business of taking deductions from the loan interest that accumulates, because that is not something that is permissible under the current tax law. If you do try to take a deduction in this fashion and you get caught, you will owe that deduction back, plus penalties and any interest that accumulated from the time you did it to the time that the IRS figured out that you did it and weren't supposed to. And since insurance agents do not give tax advice, it's going to be mighty hard to litigate any sort of damages that you claim came about by virtue of taking their really bad advice.